Our credit outlooks offer in-depth insight into credit in 2019 and beyond. I'm Tony Stringer, Chief Operating Officer of Fitch's Sovereigns Group, and I'll be discussing the credit outlook for sovereigns over the next 12 months. Joining me are James McCormack, Global Head of Sovereigns, and Shelly Shetty, our Head of Latin America Sovereigns. So let's get started. Turning to you first, James. What are your expectations for sovereign ratings over the next 12 months?
Well, we think 2019 is going to be quite different from 2018. In 2018, we saw more upgrades than downgrades. That was the first time since 2011, so a little bit unusual in recent history. 2019, if we look at the outlooks that we have in place for developed markets, they're even, so we don't see any trend or any evident trend in developed markets. But for emerging markets, we're starting to see more negative outlooks as we head into the year than positive outlooks. So if we just look at the outlooks alone, it would suggest that we're probably going to see more downgrades than we're going to see upgrades in 2019. So a little bit different than what we saw last year.
Okay. Shelly, turning to you, with new governments in both Brazil and Mexico, what are you expecting for those two countries in 2019? And also, what are you expecting from a broader perspective in the Latin America region?
Yeah, first starting on Mexico, which we've already revised the outlook on Mexico's rating to negative, and that really reflects our view that there is clear concerns on policy environment under the new administration of Mr. Lopez Obrador. Two or three key things to be watched here. First is his stance on the energy sector reform. We think that's very key for the long-term development of the oil sector in Mexico. We see that from the recent statements that perhaps they're hitting a pause button on energy sector implementation. The second thing to watch is how the fallout from the airport cancellation works out for Mexico. They've already issued $6 billion in international capital markets, so that is generating a lot of uncertainty. And final point is going to be on the fiscal policy side. We're going to have a 2019 budget very soon, so we are going to see whether it's going to be a credible budget and whether we're going to see continuation of primary surpluses and a trajectory of debt reduction. Turning to Brazil, so far we've seen that market has given a thumbs up to President-elect Bolsonaro. However, we are a bit cautious. We want to really see or focus on two things in 2019. The first really will be whether the improvement in confidence that we are seeing in Brazil really translates into economic activity and investment turnaround in Brazil. And the second thing really will be the actual implementation and passage of reforms, and the Social Security reform is going to be pretty key for us in 2019. More generally on Latin America, I would just say that clearly we have 3:1 ratio of negative to positive outlooks. So clearly there's scope for greater credit deterioration going into 2019.
Okay. So macro instability and currency volatility and depreciation were big features that affected both Argentina and Turkey in 2018. So what is the recovery looking like, the recovery path looking like for both those economies? Maybe starting with you on Argentina, Shelly.
Things are going to look very complicated in Argentina in 2019. We are still forecasting another negative growth number in 2019 after about 2.7% contraction that we're expecting in 2018. Yes, lower inflation could help. Some stability or greater stabilization on the macro front might help. Soy harvest will normalize, that will help. However, we do think that tighter monetary and fiscal policy is going to weigh on growth, and the key risk to watch in Argentina next year will be election. This is going to be a real market moving event for Argentina. A lot is at stake here, whether we're going to see policy continuity or policy reversal, or actually the adjustment in the pace of policy adjustment post-election is very key to watch, especially as Argentina is expected to return to capital markets in 2020 as the IMF disbursements will taper off.
Okay. And James, Turkey?
Yeah, also a difficult year for Turkey. Some similar issues, not an election in 2019, but I think from a growth perspective, we're penciling in a number that's less than 1% in terms of GDP growth for the year for 2019 for Turkey, so that's not good. That'll put some pressures on public finances, but I think where we're seeing a correction and the good part of the story, if you will, from the depreciation is really the recovery in the external sector. So that's the main pressure point really for Turkey from a rating perspective is on the external finances. Now we're starting to see some much more positive numbers in terms of the trade balance and in terms of the current account deficit. And this is consistent with what we've seen in depreciation episodes in Turkey in the past. The economy, from that perspective, recovers very quickly. It's not going to recover from a growth perspective because part of the recovery on the external side is a contraction of imports. So this collapse of imports means weaker GDP growth. But from an external financing perspective, it's an improvement. So weaker growth, better trade performance, better current account performance, higher inflation. We're still stuck with high inflation. So also a complicated year, as Shelly said, in Argentina, but similarities and differences with Argentina.
Okay. So finally, one of the themes next year we think is going to be global tightening of financial conditions. How do you see this monetary policy tightening playing out, particularly from the Fed and its implications for other economies?
Yeah, there's no more important central bank than the Fed, so we're starting to see the implications of it already. Not necessarily in the U.S. because policy rates are moving higher, longer-term yields moving higher, then coming back down again when markets get concerned about growth, so there's a little bit of volatility at the longer end of the yield curve. But if you look outside of the U.S. and you think about financing conditions, we can already see some evidence of it's more expensive for dollar funding for entities that are raising that outside of the U.S. So I think we're already starting to see that. That should play out into 2019. And for emerging markets, really the big issue is a strengthening of the dollar, which we think will continue into 2019. It's the single biggest risk for emerging markets, always has been. And that's something that we think is going to continue with higher interest rates in the U.S. We don't see the ECB raising rates next year, and we certainly don't see the Bank of Japan doing it. So that interest rate differential and growth differential that the U.S. has with other G3 economies should push the dollar higher. That's going to be a stress point for emerging markets.
Great. Thank you both for your insights, and thank you for watching. For our full Global Sovereign Outlook report and all of our 2019 reports, please visit our website.